This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome each and every one of you, especially the folks that are joining us for the first time, whether you are planning on just being a fly on the wall tonight and watching what's going on and listening to some of the stock symbols, or if you're a regular participant. I have a very strong feeling that you're going to enjoy tonight's presentation. We have David Bernstein with us on the line here as a participant, and I've been working with David for a while now. And again, a shout out to those who were part of the Atlanta Option Group that was organized by Joe Murad. We are making mention of that because Joe, who passed away not too long ago, left a very strong group of folks who were more or less intrigued and participating with the Option Club out there at Georgia Tech. And I had the opportunity to present a good number of times out there, and we're planning on putting together an online monthly option group that is focused on that particular club. So stand by for more announcements on that. If you are a member of the option group, then please post something in the Q&A box down there that lets me know that you are part of that group, and I'll be more than happy to take some questions from you. I just put a symbol on here. This is /ES. This is the S&P E-mini. And I drew a line on here, which before we got started, which was the support level. And you can see that the price has dramatically dropped below that support level. And that's typically what you'll see when the price action drops below support. Now this chart will go minute by minute. And you can see down here there is an extreme reading on the CCI, which that's oversold. And it's starting to turn up. And so when you see that happening and you start to see volume dropping, even on a minute-by-minute scale in a thinly traded market, you could say, well, I think the stock is going to bounce here because the CCI is starting to indicate that. Well, we'll have to see whether or not that does that. But for the most part, what I'd like to do is go over and review the markets as I laid it out for you in the expiration. On expiration Friday, I recorded the weekly alert, and you can see here these are my lines that I drew. And I want to go over each and every one of the markets, and then we'll go into your individual stock symbols and look at some of the ticker symbols that you're looking at and planning on trading this week. Obviously, the markets are closed today for Martin Luther King Day, and so we're going to have a shortened trading week this week, and a shortened trading week that follows the monthly expiration for options. And if you, again, have been following along with my reports, you'll know that the week after the monthly options expire is generally the most volatile. And so I am expecting the volatility index to go up this week, which in turn is inversely related to the S&P. I'll get into that in a little bit. But if you look at my charts here, you'll see that there is a wide divergence right here from this 20-period moving average. And on Friday, again, that was the 17th, we have that little spinning top. It's a very small body candle, almost considered to be a hanging man. A hanging man would have to be a longer shadow and a higher body on that. But for the most part, there is a gap below the market here. Doesn't look like much, but if you look on that day, which is the 15th, the high from that day was 291.24. The very next day, the low was 291.47. So you do have a gap there It's about 20, what is that, 23 points, 0.23 points of gap, and 80% of the time gaps fill. So if, let's say that the gap looks like it's going to start to fill on Tuesday or Wednesday, I did a 2-week forecast here. You see this, I projected this out in time, knowing that this was going to be a shortened trading week, and I'm continuing this into next week so that you can get an idea. So for the diamonds, if you're new to my weekly market report, then understand that the end of that line, notice I'm going to start mentioning numbers for you, for those who don't have Thinkorswim and can do this. But if you look, the end of that line is 288.66. All right, so we closed at 293.27 on Friday. A 2-week drop, again, if this forecast works out, my target is 288.6. Keep that in mind. The other thing that I noticed is that while we were setting higher highs, record highs that is, on the diamonds, notice the CCI down here was showing lower highs. That is known as a negative divergence. In a strong upward trend, the CCI would still be pressing the highs as the price was pressing the highs. But the CCI will most often lead the stochastics and even the price. That's number one. So we have a wide divergence, a negative divergence in the CCI. We have a drop in volume on Friday, which tells us that the buyers are starting to lose some of that momentum. And again, the end of that line is going to be very close to what I believe the 20-period moving average is going to be, because the moving average is down here at 287.45. But as the stock continues to stay above that moving average, the moving average will be drawn up towards it, and I think they'll kind of meet in the middle somewhere down here, right? So that's the diamonds. If you look at a more broad-based index in the Russell 2000, we obviously had a more dramatic turn in the CCI, and the negative divergence came from the stochastics. Now, if you don't know anything about stochastics or the CCI or oscillating indicators, then stay tuned, because these oscillators that I have down here at the bottom of my chart are my two favorites, with the CCI being my ultimate favorite and the stochastics is secondary. It's more or less a confirmation to what I'm seeing on the CCI. Price always is the most important thing to look at. And let me see if I could find this. Trader checklist. I think I have it here somewhere. If I don't, I will see if I can get the trader checklist. Where is that? Trader checklist. Maybe I had it as trading checklist. Hold on. Let me see if I can pull this one up. And there it is. Okay. So I'm going to see if I could, maybe I could put this in as a handout. Let me see. Is it too late for me to do that? Let me see if I can do that. Hold on. Let's see if I can get my trader checklist here. Here, okay. Let's see if I can do this. I'm going to grab it here, and I'm going to drop it right there. Oh, look at that. It's the first time I've done that, actually. So the trading checklist is now in the file as a handout. All right. So if you want it, go ahead and grab it, copy it to your computer, and let me go through it with you right now. I put this together just before I was doing the trading technical analysis boot camp in Miami with Pete Najarian. Pete and John host the Fast Money show on CNBC, and we had a handful, we had about 12 people that came for that boot camp for 2 days, and I put this together for them. So what I think this will do for you is help you weigh the evidence. All right. Notice it's not saying, okay, buy it or sell it. It's basically taking you through the checklist that I use when I'm looking at a market, an ETF, an index, an individual stock, or a futures contract. the first thing I look at is what kind of a candle is that, all right? Now, going back to the Russell 2000, you can see that's a red candle, right? A red candle is generally taken as a bearish candle because you have a red candle that follows 4 green candles in a row. This is known as a stale green light, and now we have a red candle, right? So if I am going back here and I see, okay, that's a bearish candle, I'm going to put a check mark or an X or whatever you want to do next to bearish, right? Now, the Russell 2000 is going to measure volume. If I looked at the diamonds, okay, I'll go back to diamonds and go to the checklist with you here. The drop in volume as the price is going higher for the diamonds would be bearish. Okay, so here we go. Put another one there on the scorecard. Is there a wide divergence above or below the 20-day moving average? Well, there is a wide divergence above that. Okay, so there you go. There's another bearish check next to that indication. Are there any gaps above or below the market? Well, we did mention on the diamonds there is a gap below the market. What I did not mention is that there's still a gap far below the market, all the way down here. I'm not going to mark up this chart too much because I do leave my lines on for next week's or at the end of this week's market forecast, so I have to leave that on there, right? So there is a gap below the market. That is bearish. Are the stochastics overbought or oversold? Well, we see that it's overbought. That would be bearish, right? So again, I'm just going right through here. Bearish. Is the CCI overbought or oversold? Well, we already know the answer to that. And you see the CCI is overbought and starting to turn down. You see that? All right, keep going. What do we have here? Is the CCI crossing above or below the momentum line? It is not. So this would be neither bullish or bearish. However, if the CCI, which is already overbought and turning lower, if it starts crossing down the momentum line, which is the middle black line here, that would be extremely bearish, and then we would maybe even put 2 or 3 X's in this column. So what do you do with a checklist like this? I see everything checked here, with the exception of the last one, which is still neutral, is bearish. So if I'm thinking about buying a stock, and all of the evidence is weighing on the sell side or the bearish side, at least the charts are telling me, hey, you know what, AJ, hold off on that buy idea for a little while. That's what that's doing for you. So again, take that checklist and use it. And I would say use it and even abuse it, even when you're not trading. What I would say is, and rarely do I ever give homework after a webinar like this, but I would say go over and pick 10 stocks, print out 10, I'm old school, print out 10 of those report cards of the traded checklist, print out 10 of them, and keep score on 10 separate, even random stocks, and see how that works out. Before you actually put your money on the line and risk that, I would say use that checklist over and over again. Now, when we ultimately get to your stocks, I'm not going to keep whipping out this traded checklist. I know it like the back of my hand. I will go through it with you very quickly as we go through rapid fire stock analysis. And for the option traders that are on with us tonight, understand that if you're seeing a bearish signal, there's a multitude of strategies that you could overlay on that. You could sell calls, you could buy puts, you could sell credit call spreads, you can do diagonal calls, put spreads, you can do ratios, you could do a lot of things to take a bearish position when the signals are going bearish, and the opposite could be said for when you're seeing bullish signs on the chart. So again, practice this by I don't want to say trial and error, because there's very little error here. It's just basically reporting the evidence and keeping a scorecard against it. All right, so there's the diamonds. Now let's go to the spiders. And same thing. What do you have? Well, what kind of candle is that? Can anyone tell me? Let me zoom in a little bit more. Can anyone tell me what kind of candle that is right there? Who wants to be the first one to answer? Let's see. I know there's a little bit of a delay. Richard says it's a hammer. Well, close, but that's not the answer. A hammer pattern, Richard, is actually found here. See, this would be a hammer pattern. A hammer pattern is found at the end of a down leg, and the shadow is 1.5 to 2 times the length of the body. A perfect hammer does not have a shadow above it, right? And it's found. Okay, Gene is absolutely correct. Todd is correct, and Steve is correct, and there's a lot. Bert, you're correct as well. That is a spinning top. Now, some of you came close and answered a hanging man. A hanging man would have to have a more pronounced shadow underneath with no shadow above. So it's close. It's very close. The best answer is a spinning top, which is a sign of indecision. Spinning tops are usually found at the end of up legs or down legs. Here's more or less a spinning top found at the end of an up leg, it reversed. Here is a spinning top. See, up, 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 spinning top, it reversed. Who answered doji? Let me see. Dylan said a doji. Dylan, this would be a doji here. This is like a cross. Here would be a doji. There's no color to the candle. Let's see if I can find another doji. Here would be a doji. You see, spinning tops have a small body, whereas a doji has no body. It's just a cross. It's when the opening and the close are exactly the same. So again, going through the evidence here, that would be more or less a bearish sign because it's a sign of indecision at the end of an up leg. Now, going through the checklist, there is a wide divergence above the 20-period moving average. That would be bearish. The volume, however, is not bearish. That actually would be bullish. So if we're looking at the spiders, okay, and where did my preview go? Where is it? Did I lose it? Checklist. There it is. All right. So type of candle, that would be more bearish than bullish. The volume would be bullish because the volume is showing increase volume on the way up. The divergence is bearish because it's called the rubber band effect. There are gaps below the market down here that have not yet been filled, so that's going to act as a price magnet, right? So the gap would be bearish. The stochastics overbought, that's bearish. CCI overbought and hinging lower, that's bearish. So everything else is bearish. So again, using the spiders or SPY as it's not crossing below the momentum line, at least not yet. But again, weighing the evidence, it's not a perfect bearish all the way down, negative score all the way down on the card. There is one indication, volume, which is bullish because it's increasing on the way up. So weighing the evidence, I still think there's more X's on the bearish column than the bullish column. So that would still be enough for me to not buy. It would be enough for me to not buy. Now, think about this for a second. If I'm long SPY, or I'm long the E-minis, or I'm long an S&P stock, all of that evidence is still pointing more towards the downside. However, if I see a drop in volume, let's say tomorrow morning or towards the close yesterday, if I see a drop in volume and all things are the same, now I would actually start selling out of my position. I would be scaling out, right? So at first glance, the scorecard is telling me at least don't buy, but if I'm long it already, I am now starting to consider on any drop in volume to start to get out of any long positions. You see? Now let's look at the VIX because the VIX is inversely related to the S&P. Now, if you're following along with the weekly market report, you can see that this would be a hammer pattern here. See this? This small body candle long shadow underneath, very close to a hammer pattern here as well. These long shadows underneath the price action tells us that the buyers tried to push it back towards the close, and they did. Notice here on the VIX how long shadows underneath generally result in short-term rallies, whereas long shadows above the candle generally result in lower prices after that long shadow shows up, right? So for those who pay very close attention to the shadows, right, that would be mentioned or noted on your trader checklist as part of the candle. What kind of a candle is it? A long shadow above the candle is more bearish than bullish. And you can see, again, going back on the VIX, you see these long shadows above the candles, again, generally mean lower prices on the VIX, whereas the lower candle or the candle under the body is more bullish. So my forecast for the VIX is higher. I do think that the volatility index is going to increase. You can see that the CCI is turning up. CCI is moving higher out of an oversold condition. It's still moving up. So again, if you're doing the scorecard on the VIX, you're going to see more bullish indications than you will bearish. And in turn, the VIX is inversely related to the S&P. So you put 2 and 2 together and figure that one out. Now the Qs. The Qs, same thing. We have, same thing as the Spires. This very close to a doji, very, very close. It's a small sliver of green there, so it's still classified as a spinning top. The volume is still higher, so that would be bullish. But everything else right down the line, wide divergence from the moving average is bearish. You got gaps below the market, way down below the market down here. This is a very pronounced gap after a major hammer pattern back here. So there's a gap down on the Qs, down right around 201, 202. So that would be a dramatic drop for the Qs if that were to fall lower. There's also a gap down here. So the gaps below the market are more bearish than bullish because they act as price magnets, and there you go. Now, for those of you who have been following along, I was tracking OUSA because I had a talk with Kevin O'Leary in Vegas. Todd, you were there, I believe, when Kevin O'Leary was walking off the stage as I was walking on the stage. I had a conversation with Kevin. I like his fund, but I don't think it's worth my time to analyze this every single week because it's a good cross-section, but it pretty much follows the markets as a whole. I just don't see major volume in this just yet, all right? If you look at the volume here, if it had more volume, and I might pick it up, right? If you look at the volume, there were only 38,000 shares traded on Friday. So when the volume starts picking up to about 500,000 a day, I'll start analyzing this one again. If any of you have a special need because maybe you're trading this one, you want me to analyze it, maybe I could do it from time to time, but to do it every day, I try to keep my weekly market reports to about 8 minutes because we found that when you start going over 8 minutes, you start losing the crowd because with the way technology is today, good luck trying to keep someone's attention for longer than 3 minutes, right? That's just the way it is. People want it now. They want it, no salesy, anything. They just want the information. They're going to get on with their lives. And even to spend an hour on a webinar is a long time these days, but I want to deliver the content for you. So that's what we're going to do. All right, so we did the diamonds, we did the spiders, we did the Russell 2000, we did the Qs, we did the VIX. Now, let's see who, Sebastian has a question, and while I'm answering these questions, why don't you start typing in your stock symbols because we have a lot of time left. I'm going to go over as many stocks as we can. There's a couple of questions here. One is from Sebastian. Why is a gap considered a magnet? Pro traders need to cover their positions. Okay, well, first of all, let's go to let's look at one. Let's look at a crazy stock, BYND. Okay, this is Beyond Meat, right? And I missed out on a $30,000 trade because I was trying to work the middle on this one. I went to buy puts on this day, and I was off by 15 cents. On that day, right there on January 14th, I put in order to buy in-the-money puts, and I missed out. Now watch. This is one that has gaps below the market. Now this is specifically going to Sebastian, right? This is a gap. What causes a gap? Let's think about that. There's actually several reasons why a gap would be formed in the first place. But basically, a gap is formed because news or some type of analyst report came in either before the stock opened up on this day or news came out after the close of this day. And what happened is people rush in and they overreact. That's generally what happens. There's an overreaction. Now let's build on this, okay? Because you have to know what causes a gap, and most importantly, you have to understand how are gaps traded. And the how gaps are traded will help give you the answer as to why they fill. All right. So here, let's say the market closes, and the market closes on a price of $96.07. All right. Ding, ding, ding. The market closes at 4 o'clock. At 4:30, an analyst comes out and puts a price target of $130 on the stock. Now remember, it's trading, $96 on the close. XYZ Midwestern analyst comes out, puts a short-term price target of $135 on the close. Boom. The next morning, the market makers now, these aren't the evil villains. They're market makers. I used to be one of them, so be careful how you talk about them. They're not always out to get you. No, that sounded weird, right? Not always out to get you. But what happens is the market makers look at their what's called the pending folder, and they see a buildup of buy orders coming in as a reaction to the analyst putting in the next highest price target. You follow me so far? So the news is out. The general public is already putting in buy orders in reaction to the good news. Now, you have to understand, the number one responsibility of a market maker is to provide liquidity. So what are they going to do? They have to fulfill or fill the buy orders that are coming in. So they buy for their own accounts prior to the market open on this day. They're buying for their own accounts. They have to, because if they just sell to the pending, they're going to wind up being short here, and they're going to lose a lot of money, and they don't want to lose a lot of money. So what they do is that in the pre-market session, they will start buying as much as they can up until and even over and above the number of shares that they have coming into their folder as buy orders. Long, dramatic pause to make sure that sinks in. News is out. General public is coming in with buy orders. In the pre-market session, the market makers are going long as much as they can to offset the buy orders that are coming in. So what happens is, as the market's opening, there is a flood of market buy orders that come in. The market makers are celebrating here because they're already long, right? Towards the end of this move, they are now in the first 2 minutes, 3 minutes, whatever it is, the market makers who are already long now start to sell their inventory to those who are trying to buy it. So now the market makers are offsetting their position. Now, let's break this into two parts. I'm going to take a little bit more time than usual to explain this because this is really important. Now, I've been tracking gaps for almost 40 years. Nothing has changed. Nothing has changed with regard to gap trading. 80% of gaps fill. 80% of the time after they fill, prices reverse. And I'll show you what happens after they reverse as well. Now, what happens is all of these buy orders that are coming in pre-market are those people like yourselves who are on top of the market. They're probably going to make money even buying from the market makers, because generally after a gap is formed, we see a continuation of this momentum. Why? Because on day 2 here, the procrastinators who didn't get in on day 1 are now reacting late to the upgrade by the analyst and to the upswing by the day traders. You follow? So procrastinators get in. Sometimes they'll be day 2, day 3 of this upward move. Now, when these people here get in, they are not in as investors. They are in as day traders. They're looking to make a profit, and that's it. So what happens is, follow me here, they get in all throughout the day. The next day, where does the market open? On this day, someone tell me, where does the market open? Don't give me a price. Tell me where it opens relative to the candle. Who wants to answer that one? Let's see. Who wants to? All right. Let's see. I'm waiting for an, again, we have delays. There we go. Sebastian has it right. On day 2 here, the market opens here at the top of the red box, that known as the body, right? Now, when I finally saw this, right, I saw the market gap up in a big gap up. Then I saw the market go up to this high. Now, while I was looking at the market, from the opening to this high, this was all green. At one point during the course of this day, this was all green. But by the end of the day, towards the end of the day, it was starting to sell off, and I saw this long shadow. And that just so happened. I don't know if Mike is on the line with us right now, but I was on the phone with one of our coaching students, Mike, who is an E-mini trader, and he watched me put the order in to buy puts here. But because Mike was paying me for my time, I didn't want to spend time, wasting his time trading my account. So I put the order in and I left it. Didn't get filled. I will tell you that if I wasn't on with Mike that day, I would have been filled, because I would have just went to the market on the last minute of the day. But anyway, I saw this as a technical trader. I saw this gap below the market here. I saw this long shadow above the market here. I want to go long, and boom, I'm going to go long puts, which is short the market, and boom. What happens? Day traders are getting out. You have to understand, they're getting out with big profits here, because the stock literally gapped up. It gapped up almost $15 here, right? From this high, actually from that close, which is 114, it opened up at 125. So that's $11 of gap. These people, even if they bought on the high or close on the close, they're already up $11. So they're taking profits, because that's all they're doing. They're day traders or short-term swing traders. So what happens is, as these people get out of their positions, the profit taking starts pushing it down. Where is it pushing it down towards? This gap fill, right? So once this gap fills, all of the profit taking by the shorts and the longs, all of the profit taking starts exhausting itself down here. So remember, all the people who are taking shorts are looking for this to fill as a target. So once this fills and they're short, they're going to cover the shorts, which then turns the market around. Sebastian, I know that's a long answer. Or excuse me, that wasn't Sebastian asked the question. Who was that? That was Richard, right? Okay. So what happens is, gaps are a strategy that are traded quite often. You got to know when to get in. You got to know when to get out. You got to know how to monitor them. And I would say, out of that big lesson that I just gave you, try your very best not to trade against it until you see the technical signals start to move opposite and start to pivot. Okay? All right. So, that was Sebastian's question. All right. Now, Jim has a question, and I'm going to start getting to some of because Dennis Woods put in there. Dennis, I'm looking forward to speaking with you as well. one of our coaching students. We have Jim here is asking, help me understand why the last candle in the VIX is a hammer versus a spinning top. Okay, here we go back to the VIX. The last candle. All right. This is a hammer here. This could be considered a spinning top. It is. It's close. Let me just say this, Jim. If the shadow above this candle here on Friday was smaller, that would be a hammer. All right. The color of the body doesn't matter. What does matter is the fact that we're seeing long shadows. Of the past 3 trading days, we're seeing longer shadows underneath than we are above. And that tells us that the sellers on the VIX tried to push it down but couldn't keep it down. The other thing is there's a support level here. So the sellers actually tried to push it below support, but they couldn't. All right, so hopefully that helped you out. All right, now let's go right to Dennis and AMRN. This is one that I am absolutely watching, and I have been tracking, as you can see. Let me get rid of all the lines. I do have a price target on this one of 1787 because I am looking to get long this stock on this gap fill, interestingly enough. All right? So if one other thing I want to make sure that everyone understands is that if you put in a stock symbol, please let me know what your intentions are. Or if you have a position in the stock, that also helps me help you better with risk management. All right? Now, Dennis says, AMRN looking to go long when the gap fills around 18. Well, there you go. This is my price target. You're only 13 cents away from my price target right here. I have a price alert. When that fires off, now I'm not just going to buy this thing when it hits my line. I have to watch the candles and see if there's a pivot point. I also want to watch the oscillators to see if they're going up. I want to see if the stock is dropping on lower volume. I want to make sure that's happening. But as it stands right now, Dennis, let me zoom in a little bit more because that looks very much like a bearish harami. That is. Let me make sure. The opening on that was, actually the close on that was 2006. The opening on that was 2008. All right, so that's not a bearish harami, but it's pretty darn close to it. If this had opened 2 cents lower, that would be harami. However, that is a spinning top, right? There is also resistance at this 20-period moving average. We have some mixed signals where the CCI is starting to hinge sideways while the stochastic is still going higher. The volume is dropping. Now, if we were using our trader checklist, this would be a mixed bag of signals, right? Because we don't have a wide divergence above the 20-period moving average. We don't have clear signals on the stochastics yet. And we don't have an extremely bearish candle right there. So again, if you're looking to weigh the evidence, this is just telling me wait until you see a more convincing signal. The good thing is, again, for those that are looking to trade it, there is a gap below the market that would be filled around 18, right? So keep that on your watch list. All right, now Todd is looking at Google, all right, Alphabet, I still call it Google, all right, GOOG. Todd, you have a couple of positions in there. I'll try to go back and forth to give everyone the chance to look at their positions. But if you could please let me know. Okay, there you go. So Todd, you say got in before the breakout on Friday on January 31st with hopes for roll diagonal and longer position. Okay. All right, so you got in. You got in meaning you got in long? I'll wait for that answer because that's important, all right? Because there's a lot going on with this one. I'm going to go back to check that. I'm going to go to the charts right now. But let me know if you're long or short on this one. Because here, let's go to the checklist, right? What kind of candle is that? That's a long green candle. That's bullish. That's bullish. Put that as a bullish check or X on the bullish column. There is a wide divergence from the 20-period moving average. That's bearish. There are gaps below the market. That's bearish. The volume is increasing. That's bullish. Stochastics is overbought. That's bearish. CCI is overbought but turning up. That's bullish. It's still turning up. So again, you got a mixed bag on this one. So I'm still looking to see if you're long or short it. Let me know, please, so I could tell you what you got to watch out for. Now, the first thing I would say for anyone, okay, you placed the trade in hopes of the 1490 filling and running through so I can roll vertically. I still don't know if you're long calls, long puts, if you're overall long short. Just give me your bullish, bearish. Just pick one. You're bullish or bearish. Okay, your long calls. All right. All right, now here's what you have to watch out for. Todd, and everyone, take notes, okay? See, I could do this without having to be a registered advisor because I'm doing this in public on the general audience. You're submitting stock symbols. Here we have Todd, long calls on Google. The stock is going up. It's going up on high volume. If you're long calls, what do you have to watch out for? Well, if you're thinking about turning this into a diagonal spread of any sort or lessening your long position, the first thing you have to watch out for is the shape of the candle tomorrow as you approach the close and the volume. So for instance, if you have a small body candle anywhere in here or even higher, the stock could come in higher. I don't know. But if it's higher but a small body candle on lower volume, that in and of itself is going to be extremely bearish. So if I'm already long and I have a profit in this position, I would be considering lessening my long position and potentially taking some of that money in the form of cash credits to my account if I'm an option trader, right? So the volume is going to be the telltale sign. That is the ultimate leading indicator, and it is a leading indicator. If, on the other hand, we see another green candle higher with a higher high, higher low, and the volume is even higher than it was on Friday, then Todd, hold on to the calls and do nothing, right? See, this is where technical analysis really helps you make a better decision there. And again, for anyone who's part of the option club, the Atlanta Option Club, if you remember when Joe Murad had me there, this is where Bill Johnson and Bill was overlaying option strategies on top of my technical analysis. This is where the rubber hits the road. You know, you're not going to have, anyone and any option trader calling you up and saying this is what you need to do. The charts are literally telling you what to do, but the challenge is you have to learn how to read the charts. And again, I think that traded checklist is really going to help you. So again, just to reiterate, if you came late, I have a trading checklist in the handouts down at the bottom of the control panel. That is yours to keep. Go ahead, get it, print it, copy it, hand it out to your friends and family. I don't care. I'm not charging anybody for this. I could only hope that more and more people start weighing the evidence instead of listening to talking heads on these financial programs, because they're certainly not going to tell you when to get out of positions. All right. Now, Todd, I'm going to go back to your Apple position as soon as I get to Annie, because Annie is one of my mentor students, and she's a crazy trader. I mean that in a good way, Annie, so don't hold that against me. Let me tell you, Annie is one of the biggest risk takers I know. She's been very, very successful, took a very small amount of money, turned it into a very large sum of money, and continues to trade big positions, sometimes to the point where I shake my head and I go, I wouldn't do that, but Annie does. And Annie is following the charts. Now, she has Walmart right now. Annie, I don't remember talking about this one with you. Do you have, you're looking to buy. Okay, that's what Annie's position. All right, now, let's do this. Let's weigh the evidence. Annie's looking to buy. All right, this could be anybody. It could be anybody, Annie included, but let's weigh the evidence. Remember, I'm going to go back to Walmart. Remember what we said about the general markets in the weekly market report, right? DIA, that looks more bearish than bullish. Russell 2000 looks more bearish than bullish. SPY looks more bearish than bullish. VIX, inversely related, is looking bullish. That's bearish for the market, right? QQQ. That is looking fairly bearish, right? So now we go to Walmart. If the general market start going down, what do you think Walmart will do in sympathy to the general market? Even if an analyst came out and upgraded the stock, yeah, that would probably cause it to go up in the morning. But if the markets were down big, Walmart would probably go down with the markets. All right, so you have to consider the big picture before you get into your individual stock as well, right? So let's look at the evidence. We have a bearish engulfing pattern on higher volume. See that? Dramatic pause again. Bearish engulfing pattern on high volume. What has happened the last few times Walmart had bearish engulfing patterns on high volume? Here's a bearish engulfing pattern on high volume. See that? Let's see. We have any other bearish engulfing patterns on high volume? Bearish engulfing pattern here on higher volume. Here. It went down. I think, Andy, you know where I'm going with this, right? Bearish engulfing pattern. Now, it didn't completely break down. It just went down, right? It doesn't look like much on the chart here, but that closed right around one. What is that? That closed right around 115. The stock wound up dropping to a low of 114.40 2 days after that, before showing a bullish engulfing pattern. Now, let's, again, weigh the evidence. Bearish engulfing pattern, 80% of the time stocks drop after a bearish engulfing pattern. When you have a high volume, that supports the idea sellers are coming in. We have a gap below the market down here around 108, right? That's going to act as a price magnet, right? That price magnet will tend to draw prices lower, right? We talked about that already, right? All right. Let's look at the stochastics. It's oversold, but notice what's happening. It's oversold, but starting to turn back down again. Interesting. CCI hinging lower again. So, again, you might have a mixed bag, but my gut is telling me from the price and the formation of the candle on higher volume, that's telling me that the sellers are still have more control than the buyers. So, to answer the question, if you're asking the chart, I'm thinking about buying it. Should I buy it? Annie, the charts are telling you, hold off. Just hold off until the signals get more bullish, or until the gap fills, or until we show a bullish engulfing pattern versus a bearish engulfing pattern. What's happening in my chart here? Let me get rid of these lines here. Get that back. All right. So again, it's going to be just like any other market that we look at. You want to be buying with the buyers, or when the buyers are dominating. All right. I'm going to hop right back to what Todd said or suggested with Apple, because I know a lot of people are asking about Apple. So I'm going to go with that one here. Hold on. AAPL. Now, this is one, AAPL. I was talking to Pete Najarian. He cannot get himself to sell Apple, no matter what you tell him, whether it be a technical signal or not. He just can't get himself to sell it. Now, there's some people that are just going to hold on to Apple until, it's a multi-trillion-dollar company. But let's look at Apple, all right? You have a green candle on higher volume. Right there, it's telling us the buyers are trying to push it to new highs, right? Green candle, higher volume. There is a wide divergence from that 20-period moving average. There is, but the volume is increasing, right? We have the stochastics turning higher again. Listen, the stochastics has been in overbought condition since the beginning of December. It's staying in an overbought condition. The same thing for the CCI. It's starting to turn back up. So right now, I can't get myself to short it. However, if I'm long calls along the stock or have anything to do with a long position on this, the charts are just telling me hold it until we see more bearish signs come up. That's it. All right, Phil is asking for Macy, ticker symbol M. Let's see what Phil, no position, think of purchasing shares and writing covered calls to generate income along with the 6% dividend. Well, here's one that I like, because Phil, what you're doing with Macy is very similar to what I'm doing with Ford. Ford also has a 6% dividend. The ex-date is coming up in a couple of weeks. I'm holding it because I want to get the 15-cent per share dividend. I love it, and I'll hold it. Now, but here's the thing. You still have to watch for a down market, even though the evidence is weighing more on the buy side. It is, right? Here's a gap that has recently filled. It's a small gap. Let me see it, if that's a gap. High, 1726, low here, 1728. So there is a 2-cent gap right here, right? Looks like the gap, I got to move that up a little bit. Yeah, I didn't draw it right to the high. But there is a gap fill right here. All right, the gap has filled. On Thursday, the gap filled. What happens? There's a small gap above the market now, right? So gap is filled, 80% chance the price will go up. The volume is dropping on the way down. That's bullish, right? Why? Who can tell me why it's bullish when you see a drop in volume as the price has gone down? Can anyone tell me? Who wants to be the first to answer? Let's see. I know I get that long delay. That's the only thing about GoToWebinar. You get that long delay in the Q&A box. Okay, someone I think is getting ready to answer. Why is it bullish when the price is dropping and you see a drop in volume? Okay, here we go. Now we got a flood of answers coming in. Doesn't necessarily mean the buyers are moving in, Robert. It means the sellers are slowing down, and Heinz got that correct. Nathan Close, the buyers aren't leaving, the sellers are slowing down. And Richard, you're correct. And Sebastian, you are correct. When you see the price going down and the volume is going down, the sellers are slowing down. This is a perfect doji that follows almost a perfect hammer, which is bullish. All right? So if you weigh the evidence, you'll notice that the stochastics is still going lower, but the CCI is starting to turn up again. So you got a mixed bag in the oscillators. There's still going to be more evidence weighing on the buy side. Now, here's what I'm going to do to help anyone, especially Phil, who's thinking about doing calls on this one. If you're getting slightly bullish, but the general markets are looking more bearish, then what I would do is buy the stock and sell at the money or slightly in the money calls to pick up the credit on the call to also allow you to keep the dividend. I don't know when the ex-date is on this. I'm not going to take time looking at for you, but I think you'll know that if you're trading it for the dividend play. All right. So that's a good play because you're going to collect an extra time premium, which I call a synthetic dividend. You will then collect a dividend. And with a stock like Macy's or Ford, a lot of times, if the stock is giving you a 6% yield and you're adding options to that equation, and this is why I tell people who don't know nothing about options, at least learn what a covered call is so that you could play a dividend play and turn a 6% dividend into a 10% yield by using time premium as a synthetic dividend, right? That would be good. All right, now, David is asking for Qualcomm. I believe that's QCOM, all right? QCOM, unless it changes the symbol. No, it's still the same. All right. Is it due for a pullback? Well, right now, this one looks like it's a cup and handle pattern breakout. So you got to be careful. This stock has recently broke out of the high. It's gapped up on the breakout, and notice we see a big volume spike telling us that this is potentially going to go higher. Now here, David, this is very similar to what we looked at Beyond Meat, BYND, right? Here you have a breakout. Here you have a gap up on the breakout. And what you're going to be looking for is a possible higher high. So see, this is where you got to be really careful because if you're trying to go long now, you've already missed the breakout momentum here by those who are already on top of this. So what I would say is you probably got 2 or 3 days of slightly higher price action before it starts pulling back. The first telltale sign of that pullback is going to come in the form of a drop in volume. And so if you're thinking about buying this on a pullback, then what you could do is erase all lines and do what I'm going to do, which I will absolutely do, is put a price alert on here. All right, I'm just going to right click and I'm going to put a price alert right here, create a price alert. And what am I going to put in here? At or below, right? If it drops to 91.95 or below, I'm going to put in my notes here, possible buy on gap fill reversal, right? There we go. Now, I don't know how many of you have a Thinkorswim platform, but Charles Schwab just bought Thinkorswim TD out. Hopefully they're not going to change this. You see how quickly it was and easy it was for me to set a price alert? Now, the thing is, I have these alerts tied to my email. So I will get the alert emailed to me, and I have my email going forwarded to my smartphone. So like I do a lot of times, I could be on my horse riding out in the Cedar Key scrubs. I'll get an alert because there's a cell coverage out there. I get cell coverage, and I'll pull my horse under a shady tree and put my trade in, as long as the signals still look like a buy. See, I don't have to be tied to my computer all day long like some of you day traders do all day long. You got your ankles chained to the desk as you look at the markets all day long. You don't have to do that. Technology is giving you the freedom to get out and about. And now here's the thing. If the stock pulls back, chances are it's going to snap back close to this 20-period moving average. So as the stock moves higher, what's going to happen to that moving average? It's going to be brought up with the stock. So as it pulls back to this gap fill point, you could also see a possible bounce off of the 20-period moving average as a newly established support level. Got that? Robert, I'm not going to have time to go through all of them. However, pick one of the 3 that you've submitted, and I will go with that. Go with that right now. If you could type in, because you have XLK, SH, and Caterpillar. Pick one of those, and I will go with it. Okay, XLK. Let's go with that. All right, XLK. There we go. The technology ETF. Now, you got to understand what I just talked about with technology is one of the reasons why technology is driving. Now, I'm going to do something a little bit different. Right now, the momentum is still moving higher. I don't even have to go through the checklist because I see the volume is still increasing on the way up. So there is a chance that this rubber band or the divergence above that moving average could get actually wider. So what am I going to do? I'm going to use something a little bit differently. I'm going to go to the weekly chart, and here's what I'm going to do for you, right? Let me move this to the right. I'm going to take this low, connect it to this low, project out to this low, and I'm going to draw a trend line. Then I'm going to draw a fan line, connecting this low to this low and projecting out. I could even go to that low right there. So I'm connecting this low to this low and projecting out. Now I'm going to zoom in to the daily chart. That's how you draw fan lines. Now I'm going to take this low, connect it to this low. There's 3 fan lines. Now we have the 4th fan line is here, and there you go. What are fan lines? I've discussed this before. I'll say it again. A fan line is nothing more than an existing trend that has accelerated in a more vertical angle. So what we're doing by drawing new fan lines is we're showing the acceleration of the trend to the point where once you start getting over 3 fan lines, it's extremely difficult for this stock to maintain vertical price action forever. In fact, I can guarantee you stocks do not maintain vertical price action forever. It is short-lived. So how do you trade a fan line? All right. This is going to Robert, right? Specifically because he submitted this. The stock is still going higher. So if you're long it, maintain your long position. However, when you have the most vertical fan line showing like we have here in fan line number 4, once that fan line breaks, there is a 90% chance that the stock will pull back to the next fan line in the sequence before bouncing. You see that? Now, that makes a lot of sense because if you notice, fan line number 3 is running parallel to the 20-period moving average. So if it drops below fan line number 4, it will most likely drop back to fan line 3, bounce off of that moving average, and now you have a new long position. At which time, and then I'm going to close with this, once you take a new long position on the bounce or pivot point on fan line 3, you have to make sure you set your stop below that most recent fan line that you're using as the signal point. Because if it doesn't maintain that fan line, guess what? 90% chance it's going to go to the next fan line in the sequence. I'm probably going to do a market shot video on that, and I'll post to our library so everyone understands how to trade the fan lines. We had a really good crowd tonight, folks. We didn't run out of content. We didn't run out of stock symbols. We just ran out of time. So stay tuned. For those who are enrolled in my coaching/mentoring class, I'm looking forward to doing some calls with you this week. Dennis, I want to connect with you. Annie, we definitely have to talk especially about your Shopify position. And who else we have? David, I'm going to be talking to you as well. And hopefully the folks from the Atlanta Option Club will start to organize so that I can have a regular day that we can set as our webinar meeting for the option traders. All right. And that's it I have for now. So we're going to be posting this recording. Ken Sweeney, who's running our tech side of the website, is going to be posting this to the member page. So if you have any notes you want to review, just go to the member page and listen to recording. And please don't forget, I'm going to leave the page open so you can download the trader checklist if you haven't done that already. I went 2 minutes over. I'm not going to go a second over. Have a good night. We'll talk to you soon. Good night.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.